Hello, once again. I would like us now to solve one question on a published financial statement, and I would like us to read that question together. That is question 1, page 1. So you go to question 1, page number 1 of the questions that I sent to you. This is question 1, page number 1. So let's read together. BARTEK Limited, a company quoted on Nairobi Security Exchange, has prepared the following trial balance as at 31st December 2013. So we have a trial balance. We have details. We have the debit side and the credit side. Shillings is in thousands. So we have revenue, cost of sales, distribution costs, administrative expenses, interest on loan note, dividend paid, investment income, ordinary share capital, shilling 25 per, 6% loan note, retained earnings into bracket 1st January 2003, land and building at cost, land 12 million, plant and equipment at cost, accumulated depreciation as at 1st January 2013. We have depreciation for buildings and for plant and equipment. Equity financial asset investment, equity financial assets, equity financial asset investments, inventories as at 31st December 2013. That is the closing stock. Trade receivables, bank balances, current tax, deferred tax, trade payables. So as you can see, the trial balance is balancing at 476,400. So sorry. So we go to additional information number 1. The company issued a shilling 30 million 6% loan note on 1st January 2013. Issue cost of shilling 1.2 million were incurred and are included in the administration expenses. The loan note will be redeemed on 31st December 2015 at a premium which gives an effective interest rate on the loan note of 8%. Number 2, the company paid an equity of shilling 8 per share during the year. So that one should be, the company paid an equity dividend. Of shilling 8 per share during the year 2013. So note number 2, we are saying that the company paid an equity dividend of shilling 8 per share during the year. So let's go to note number 3. Note number 3, the company's policy is to value land and building at a depreciated cost, that is into bracket net book value. Due to recent a rise in property prices, the company revalued its property on 1st January 2013 to market value. An independent valuer attached the value of the property at shilling 72 million, land shilling 14.4 million. As at that date, full stop. So buildings had a remaining useful life of 16 years as at the date of revaluation. The building had a useful life of 16 years. So the company will make a transfer from the revaluation reserve to retained earnings in respect of the realization of the revaluation reserve. Ignore tax on the revaluation. Number 4, plant and equipment are depreciated at the rate of 15% per annum using the reducing balance method. So that is plant and equipment. You are depreciating using 15% reducing balance method. Depreciation on non-current asset has not been provided for the year. Depreciation is classified under cost of sales. So we are required to prepare a statement of comprehensive income for the year ended 31st December 2013. And number 2, we are supposed to prepare the statement of financial position as at 31st December 2013. So I would like us to prepare this statement of comprehensive income, having in mind that we are preparing in a published form. We are preparing this question in a published form. And remember, you said that the examiner may not tell you that this question should be prepared in a published form. But you should know, when you are going to your exam, you should know that there must be a question on published. So that is what should be on your mind. So when you are going to your exam, you should know that you are going to find a question which will be required to be prepared in a published form. But how will you know that question is there? So in most cases, this is how the examiner will phrase that question. Like this one is a good example. We are told that BARTEK Limited is a company quoted on Nairobi Security Exchange. So that one is one indication that this question is supposed to be prepared in a published form. Quoted on Nairobi Security Exchange. So this is not a question of a consolidation. It is not a question on bank. It is not on branch. It is not in farming, not in hire purchase, not in any other form. It is just an independent question. Requiring income statement and a balance sheet. But you are told that these are quoted company quoted on Nairobi Security Exchange. So that one is an indicator that the question is to be prepared in a published form. So the reason why I am insisting that is that when you prepare this question, normally you will not get anything. You are supposed to prepare it on a published form, meaning the format is going to be changed. How we normally prepare other questions is not the way we prepare this one. Yeah, so you may prepare it in a different way. At the end, your question will still balance, yet you will not get anything due to the format used. So let us start preparing this question. So you write BARTEK Limited statement of comprehensive income for the year ended 31st December 2013. So after writing that, you should know that when you talk over preparation of a statement of comprehensive income, we are simply talking of income statement. But I told you, when you are asked to prepare statement of comprehensive income, you write as such. You don't change the words of the examiner. So we know that this is the income statement, but the examiner has asked you to prepare statement of comprehensive income. So that is what we are writing. So after that, we move to now revenue. The way we start our income statement, we start with revenue. So we start with the revenue, less cost of sales, get the gross profit. Gross profit, you add other incomes. After adding other incomes, you less expenses to get net profit after tax, net profit before tax. From there, you less income tax, you get net profit after tax, you less dividend, you get retained earnings for the year, you add profit brought down, and then you get the retained earnings carried down. So that is the normal income statement. So this one, you write revenue. When you write revenue, and our revenue is 164,160. Our revenue is 164,160. Our revenue is 164. No, not 164, 160, but our revenue is